Great. Good morning, everyone. Thank you all for being here. My name is Stephanie Nuttall, and I'm an assistant Winona County attorney. Been, as of a little over a week ago, I've been doing that for 14 years now. And one of my, I have what we call a specialty caseload in addition to the general caseload, where I handle all of our complex financial crimes in the county. So the embezzlement type cases, and we'll talk about what that means in just a minute. So for those of you online, this is a hybrid presentation. So you'll probably see me staring off into space because I'm looking at the people physically in the audience, but I'll also be looking at the computer as well. For those in the room, ask questions. I like to ask, I don't want to stand here and talk for an hour. If you have questions, ask them during the presentation. I'm happy to answer them then. And for those of you online, feel free to type them in the chat and we will get those answered as well. I will be able to see those questions. So like I said, I've been doing this for 14 years. One of the things I like about Winona County is I get a wide variety of cases. So my current caseload, I'm supposed to be 2/3 time criminal prosecution. I handle the complex financials and I handle general felonies. So assaults, burglaries, the typical stuff that you see. I also do all of our legal advising for planning and environmental services and IT in the county. So my background, I've got a bachelor's degree in political science, bachelor's degree in criminology. I got my law degree from Mitchell, now Mitchell Hamlin, formerly William Mitchell, which is what it was when I went there, because it was a long time ago. And since then, while I was working at the county, I actually went through St. Mary's and got my master's in geographic information science. And I'm currently working on a master's in cybersecurity. So I haven't decided if I'm just doing the certificate or the full program yet. I started with the certificate and I'm about two and a half weeks ago. So learning all kinds of new stuff. And one of the things I'm excited about with that is learning how you can do financial crimes through cybersecurity. So all of this, it really does tie together. All the GIS, the cybersecurity, and the prosecution all ties together in one big government package. So what I'm here to talk about this morning, and thank you, Christy, for inviting me. This is something we've actually talked about doing in the past, presenting and talking to businesses about what they can do to help prevent embezzlement type cases. So I love the criminal justice system. I think it works really well for most things. It's not the greatest when it comes to embezzlement type cases. And part of that is because of what we have to be able to prove. And part of that is because of what the consequences will be on the end. And we'll talk about what those are as I go. But at the end of the day, the best answer to all this is prevention and what you can do to try to prevent it from happening and what you can do to mitigate it once it does start to happen. So the plan for today, maybe? Right. Probably. There we go. Okay, so I'll just tell Christy when to click. So today what we're going to talk about is what is embezzlement? What are some of the red flags that you might see if there is embezzlement going on in a business? What can you do if you suspect that it's going on or if you know that it's going on? What's the criminal justice system going to do about it? We're going to talk about case studies because when I was going through, I had originally planned on, as we went through things, talk about little stories here and there throughout it. But the more I started putting things together, the more I realized that you don't really understand the whole case study and what went on unless you know what the rules are up front and what you should be looking for. So I'm going to do I have 9 case studies that are actual Winona County cases. They're cases that I've handled in the last decade. So all of them are public record, but I'm not going to be using any names. But they are all actually cases within this county, this community that gave us some red flags to look for and some lessons to learn. And then finally, what are a few things that you can do to prevent it from happening to you? And that's really going to depend on your business. But there are some kind of overarching concepts that go with it. Next. So what is embezzlement? Everybody talks about embezzlement and everybody has an idea of what it means. And in Minnesota, you're probably not correct. Minnesota has a very specific definition of embezzlement, and it's in our Constitution. So the US Constitution has treason, and the Minnesota Constitution has embezzlement. I think it has some other ones too, but it actually has embezzlement in there. It's Article 9 or Article 11, Section 13. And it describes officers and persons charged with the safekeeping of state funds that convert those funds to their own use. And that's pretty consistent with what we think of as embezzlement, right? It's taking from your employer and using it for yourself. And that's more like, that's what the general definition is. So if you Google it, look it up on dictionary.com, you've got theft or misappropriation of funds that are placed in one's trust or belonging to one's employer. But embezzlement itself, you're never going to see that in a complaint. You're never going to see somebody charged in Minnesota with embezzlement unless it's stealing from the state. So what crimes do we see? We see theft. That's probably the most common. We charge it under theft. It's taking the movable property of another without that person's consent. So pretty easy to fall under that if you're taking your employer's money or property. And the penalties or the potential penalties for those really depend on the amount that we can prove. And we'll talk about charging in a little bit. It can be anywhere from a misdemeanor to a felony. And I've seen misdemeanor employer thefts. Actually, those generally go to the city attorney's office, but they do exist where they just took a little bit, got caught, immediately to the city attorney. There's theft by swindle, which is another version of theft where you're taking the movable property of another, but it's done by artifice, trick, device, etc. And the difference between those two, if you're ever looking at somebody's background check, is theft by swindle is a crime of dishonesty, and theft is not necessarily, unless you go back and look at the details of what happened. And so theft by swindle, we can use that in court against somebody if they ever testify. We can't just use the theft against them. So a lot of times when I charge these cases, I'll charge both for the same conduct and then let them plead to one and not the other because it's the same conduct. The other one that's also a crime of dishonesty is financial transaction card fraud. And that's using the debit or credit card of another without their consent. And that one gets a little complicated when you're talking about a business credit card, but it's still provable. And we'll talk about that as a charge when we get to some of the case studies. All right, so red flags. So you have a business and something's not right. And you're not quite sure what you can put your finger on. One of the studies I saw said that 75% of employees had stolen from an employer at least once. I would assume that that means like a pen also, you know, if you take a pen home. And I think if I remember right, the study also said that if you factor in time, so you're being paid for your time, but you're paying your own bills and running an errand, technically that's theft of time. It jumps up to 95%. 38% have stolen at least twice. But those are pretty staggering numbers. I mean, we like to think that people are trustworthy, especially in the Midwest. I think I was born in Oregon, outside of Portland, and people in the Midwest tend to be a lot more trusting of others here, which leads to a number of criminal cases on my plate because they leave their doors unlocked and people then burglarize their houses, or they trust their employees or their coworkers, and we see thefts. And that's one of the things we'll talk about too at the end, which is trust, but also make sure that there's things in place where you can make sure bad things aren't happening. So some of those red flags, changing in work habits or participation. If you notice an employee was doing really well and then suddenly starts slacking off, or vice versa. You have a slacker that's suddenly a model employee. Might just be, these aren't necessarily things that say there is something going on. There's things to maybe start paying a little closer attention. Odd cash register transactions, if you start noticing false returns, voided transactions, just things that don't look right, you can start looking a little more closely. Unexplained changes in the financial metrics. So all of a sudden there's more past due accounts. Can't quite figure out why expenses aren't getting paid on time. Things like that where there's something financially going on, but maybe you don't have an answer for it yet. Overprotective of their work. If they don't want anybody else to see what they're doing. If they suddenly start, you know, oh yeah, I'll get that to you. I'll get that to you. And then it never appears. Signs of financial distress, or that they're living above their means. If they start talking a lot more about how hard it is at home to make ends meet, or if you notice that somebody whose family normally, is living at this level and all of a sudden they bought a Jaguar, pay closer attention. Maybe they came in into an inheritance, maybe they won the lottery, but just something that kind of should trigger that warning, that red flag, and just pay a little closer attention. Trouble with transaction records. All of a sudden and this was more common back before computers. Your cash register tape suddenly got tangled up and some evidence was destroyed, those kinds of things. Invoices got destroyed, paper files got destroyed, the records suddenly disappeared, and something, oops, I spilled coffee all over them. Those kinds of things where there's some kind of a concern. It's a big deal because according to the Association of Certified Fraud Examiners in a 2016 report, the median loss for businesses is $180,000 from employee theft. Some estimates also say that 30% of small businesses fail because of employee theft. So it's something to pay attention to. And one thing to keep in mind with it too is changed behavior is more significant than just behavior itself. So if somebody has always lived above their means, not as concerning as they were fine and then all of a sudden they've got new stuff. And it's just stuff to pay attention to, and maybe take a look at your books. So you start seeing some red flags. What do you do? If you either find some kind of an embezzlement or even suspect it, there are some things that you should start doing right away. One is to document everything and start collecting records. We are on a timeline. As soon as you notice it, you're on a timeline. You actually were on a timeline, and we'll talk about the statute of limitations when we get to charging. The timeline starts the day they took the money, whether you find it or not. So we have a lot of cases that don't get charged because of statute of limitations. We have a lot of cases where we know they took way more money and we can only charge this much of it because of the statute. So you want to document it and move quickly and start collecting the documentation you need. Consider hiring a forensic audit, especially if it's kind of a complex situation. It's not always necessary. I've seen some amazing internal investigations where the new treasurer came in and put together these beautiful packets with details and annotations, and it was spectacular. And I've seen forensic audits that were not the best. But consider having a professional and clean eye come in and look at your books and look at what's going on and try to see what they can prove. If you can't do that, you can also work with law enforcement. Winona PD has a couple of investigators that focus on these kinds of cases. And when they're focusing on them, that means they're also on my desk because they're asking me questions, and I'm usually brought into it almost as soon as they come in. So we're making sure everything gets done right. You are able to talk to your employee, or hopefully former employee, if you're able to prove something. Just make sure you're documenting. Consider recording. We are a one-side recording state, so you can record those. A lot of times I see signed statements. So you meet with your employee, they make admissions, you have them write out what they did, sign it, put it in the file. None of that's required. It is helpful. And you can do all of this before you even bring law enforcement in. Usually you don't want to bring law enforcement in unless you know or have a really good idea that a crime has actually been committed. Next. There we go. So involve law enforcement if and when you think a crime has been committed, or if there's enough for it to at least trigger a criminal investigation. One of the things you should keep in mind if you are talking to your employee is you are coming at it from the perspective of an employer, not an investigator for law enforcement. So make it about the employment, make it about what they did and termination type situation, and not we're trying to get you to admit to a crime. So what happens once you bring law enforcement in? Once you bring law enforcement in, they will pick up the investigation. They'll probably ask you for a whole bunch of things that you didn't expect to have to provide. But they have tools available that you won't and that a forensic auditor won't. They have the ability to get administrative subpoenas. That's where I come in. They say, hey, Stephanie, we think that there's this financial crime going on. We want to get the defendant's bank records. I'm like, okay, here's my signature on this, and they can send it to the bank and get all the bank records that we request. We can do that there's a whole list of business records. I have a cheat sheet on what I can and can't approve subpoenas for. They can also do for other records that aren't able to be obtained by subpoena. We can also do a search warrant and get even more detailed records. So I can get cell phone records, I can get bank records, I can get all kinds of records. I can't get the content of text messages without a search warrant, but I can do it with a subpoena. I can find out that text messages were sent and who they were sent to. So if you know that they're texting somebody else about money, we can get that information. And then once they've gathered all the information, if they think there's probable cause, it gets referred to our office for review and charging. Once it hits my desk, there's a couple things I have to keep in mind. The standard for charging in Minnesota, according to the rules of criminal procedure, is probable cause. So if I have to be able to demonstrate that it's more likely than not that the defendant committed the crime they're accused of. So that's like 50% plus a hair. That's not actually a difficult standard to meet. It's pretty low. That's what law enforcement refers it over as. Technically, I can charge it at that. However, we also have to follow the ethical standards in the ethics rules. And the ethics rules say that we can't proceed with a case unless there's a reasonable likelihood of success at trial. And a reasonable likelihood of success at trial means I have to be able to prove it beyond a reasonable doubt to a jury when I get there. So if I don't feel like I can make that level of proof, ethically, I can't charge a case. And unfortunately, between those two things is where a lot of cases fall. So if I can't prove every single penny that went from point A to point B and that it's in the defendant's pocket, I can't charge it. I've had to decline some pretty egregious cases because documentation wasn't there to show that, in the case I'm thinking of, we know the person took money. She admitted to taking money, but we couldn't prove when it was taken, total amount, because the records, they didn't have records of how much was coming in. It was a fundraiser. And so money came in and there was no documentation. So they're like, well, we think it was this much because the bills were this and we had this many tickets sold, but we don't know for sure because there were some discounts and all the money got jumbled together from all these various fundraisers. And so we can't prove which one was resulted in which dollar going where. And we had to decline it. And it was a 6-figure total that we think we ended up having to decline because of documentation issues. So that have to follow the money and show it was the defendant that did it. Which sounds easy a lot of times, and it's not as easy as you think. I've actually had disagreements with forensic auditors about that one, but I got to prove the dollar went from the customer to the cash box to the defendant's pocket and not into your bank account. Some of the things about charging, we can aggregate theft amounts within a 6-month period. So I can take a 6-month chunk and total them all up to get to higher severity levels. So a misdemeanor theft is anything under $500. A gross misdemeanor theft is anything under $1,000. A felony theft is $1,000 to $5,000, $5,000 to $35,000, or over $35,000. And the different levels of felonies have different consequences associated. So in order to get to those thresholds, I can total them up within a 6-month period only, which makes it for some creative math sometimes. And then we have to deal with the statute of limitations. For most felony offenses, it's 3 years from the date of the offense to the date of charging, which is not a lot of time if it takes you 2 years to realize that there was something going on. And if it takes another year to investigate. That I've charged some literally on that 3-year anniversary. So it's not a lot of time. If the total amount of the theft is $35,000 or more, we have 5 years. But I've only ever been able to use that once. So and we'll talk about that case in a little bit. Good news is, because we're a border state, time they spend outside of the state does not count. So I've charged some really old cases because people live in Wisconsin. You live across the river in Fountain City and steal from your employer here, we can still charge you up to, really, I can go back as far as I want to because you live outside the state and it doesn't count. It doesn't seem fair in a lot of ways, but at least it holds them accountable. Yep, I think it's designed by people that most of the time they didn't live out of state and it's just a holdover on that, but it means the problem is jurisdiction. We don't have jurisdiction over people out of the state usually. So that's why if they move out of state to flee prosecution, which I think is how it's titled, but it really, the way it's written, it applies if they live out of state, time doesn't count. So once they get charged, we have a first appearance on a complaint and they set conditions of release. I will tell you right now, they are not going to sit in jail. They're not getting arrested up front. I don't think I've ever seen anybody get arrested up front on a complex financial, usually because it's been so long since it started. We don't arrest people for property crimes generally, period. And especially not old ones. And then after that, there's going to be a bunch of hearings, often with months in between. Some of these might get repeated. There might be more than one of them in there that gets scheduled. Morning, Linda. And so it takes a long time to get through the court system. I don't remember what the average number of days to get through the court system is. I want to say it's minimum 6 months, closer to 9 to a year. And on the complex financials, because they're complex, they do tend to take longer. Let's see. So we're going through the case, and I will tell you 99.9% of cases resolve with a plea agreement. And there's a number of reasons for that we'll talk about when we talk about trial briefly. But in general, plea agreements are the way to go. You always want to get those whenever possible. So the factors that we consider when trying to reach a plea agreement is what would happen if they got convicted at trial? What's the likely outcome from the judge? And that's guided by the sentencing guidelines that I'll talk about in a second. And then what's the most important factor in the case? It is rare that you're going to get a plea and an admission, a conviction, full restitution, and any other consequences. You're almost never going to get that. So the question is, what's the most important one of those to focus on? And it depends a lot of times on the organization. It depends on what they want to see. One of the considerations, because the victim always has input in what happens. And 99% of the time, we go with what the victim wants. Not always. At the end of the day, the decision is mine with what the right outcome is, but what the victim says is really important. A lot of times what I hear from organizations is they don't want the publicity that a trial would bring. They don't want because when I write complaints, one name appears in my complaint. It's the defendant's name, and it's either business or organization. Unless you dig hard, you won't know who the victim is in my cases. I'm never going to say it on the record if I don't have to. I'm never going to say it unless there's a contested hearing that we go through where we have to have testimony until we get to sentencing or jury trial. That's when it becomes more public information. So we try to protect our victims, and it's not just financial crimes. We do that in all of our cases. But if an organization doesn't want people to know that they got swindled, doesn't want people to know an employee, a lot of times they will say, I just want it done. Here's what I'm willing to agree to in order to keep this out of the public, because it will be news. So sentences governed by our sentencing guidelines, and they're considered low level, not presumptive prison sentences. 99% of the time, people that are committing these crimes have no prior record. If they had a prior record, odds are you probably wouldn't have hired them. But so there's that. But also, usually it's a crime of opportunity that snowballs on them. So they usually don't have a prior record. They're not going to prison for it. I will tell you that up front, because A, they don't have the history, and B, they need to pay restitution, and they can't pay restitution from prison. So we also have, with the sentencing, double jeopardy, which means I might charge somebody with, what's the most I've got on one of these, 18 counts for various time periods. They're only going to be convicted of one, maybe two, because they can only be really sentenced once for one set of conduct. Technically, it's ongoing conduct. It's just we had to break it into 6-month time periods. So with all of that, we have to consider that really it's only one conviction because it's one round of theft. So all of that goes into a plea agreement. And then there's the restitution. And I know for businesses, a lot of times this is a big deal. The restitution is technically under the under Chapter 611A, which is our Crime Victim Bill of Rights, victims are entitled to have restitution ordered for any out-of-pocket losses. Ordered doesn't mean they're going to repay it. Ordered means the judge says you have to repay it. If they don't repay it, unless there's set consequences in our plea agreements, it's basically going to be you need to start paying your restitution, start making those payments. You really should start paying now. Let's go. It's going to go to collections and you're still not going to pay it. You can't be guaranteed repayment if it's just ordered over their objection, usually. It can only be ordered for the offense that they pled to. So if it's contested, if we go to trial and maybe the jury only convicts on half the counts, then we get there and the judge is only going to order restitution for those particular counts, not for everything else that they were alleged to have done, unless we agree otherwise. So that's one of the benefits of a plea agreement is we can agree that they pay all the restitution, sometimes even restitution for things that weren't charged. So we have some more flexibility if we reach a plea agreement when it comes to restitution. And the other thing, the reason why plea agreements tend to be beneficial is because if it's contested, if they say, I don't want to pay restitution, and the judge has to make that decision, they can consider the defendant's ability to pay when ordering restitution. So they can say, oh, you work at McDonald's and you're making, I don't know, whatever, I don't know what minimum wage is anymore, but you're making minimum wage at McDonald's, okay, and you have 5 kids and your spouse is disabled, you can't pay anything. I'm not going to order restitution, even though the victim's out $100,000, not ordering it unless we agree to it. If they agree to pay it, then it gets ordered. And if they don't pay, it goes to collections. What I've been doing recently, probably in the last 3 or 4 years with restitution, is we take that amount of restitution and we break it into chunks, annual chunks over the time period of probation. And if they do not meet those thresholds within that time period, they have to serve X number of days in jail. So you have 30 days of jail. You don't have to go to jail if you pay $2,000 a year. But if you don't pay that $2,000 on the anniversary of sentencing, you better show up at jail. And it seems to work. We're getting more and more payments that way than we used to. All right, so let's talk about some fun cases. And Linda, for you, these are all actual Winona cases that I've handled. So we won't be using names, but they are real cases. All right, case study number 1. This was a theft from a local business. The employee was responsible for making the business deposits, and magically some of those bank bags never made it to the bank. Total provable value, and you'll hear me use provable value because this is the amount I could actually prove to charge, not necessarily what was taken. I think on this one, it's pretty close, if not exact, because they had some documentation, but on some of the cases, the unprovable is so much more. So $1,300 over the course of, I believe, 2 weeks, where I think it was 6 or 7 bank bags that didn't make it to the bank. Some of the red flags that the employer noticed, she stopped coming to work because apparently figured out that the boss knew about what had been going on because the boss was trying to get a hold of her and she wouldn't answer her phone. So those were some of the red flags that, suddenly the work ethics changed a little bit. And then there's not a lot of lessons from this one other than the employer did a really good job noticing issues right away. So saw the statement, went, hey, these deposits don't look right, looked into it, and it was caught within a week and a half of when she took the bank bags. So this was a really good one. And I started from like the most simple ones, and the last 2 I'm going to get to are really complex. So let's go through some easy ones to ease you in. Next one was the use of an organization card for personal purchases. So this employee had been issued a card for the business to use for business purchases. She decided to buy herself gas and food and go to Walmart and do some online shopping with that card. At one point, she was confronted about it and about some of the gas ones. And she's like, oh yeah, I have those receipts. I have those receipts. And then they never were brought in. She didn't provide any receipts to support any of her purchases. And eventually they also found, if you want to go to the next point. So no receipts to support her purchases. And they noticed some records discrepancies with the petty cash for the business as well. So that's what triggered them to start digging in a little bit further. And one of the fun things about this one is this person was hired in March. I don't know the exact hire date, but the transactions started March 30th and they went till June 7th. She was confronted in April about the purchases. So there were some red flags that should have been the receipts in particular. So lessons from this one is require those receipts. If it's on there, receipts have to be submitted. If they're not submitted, it's harder to question. And have clear rules for the use of an organization card. This organization actually did have clear rules and she violated them pretty egregiously, but making sure that those rules spell out you can and can't use it, because if it's just here's an organization card and no rules attached to it, I can't prove that she didn't have the consent of the business to do it. So the rules and the policies and procedures have to say what you can and can't do with those cards if they're being issued. And I'm assuming that your accountants or auditors would probably notice that and remind you, but if you have them, make sure you've got the rules in place. Number 3, so a couple of these in here are more community organizations, but they also give us some good lessons. This person was the treasurer for a local organization. Unfortunately, all the organization ones in my examples, the victims were children organizations, which makes it doubly heinous. So the kids are the ones that suffered at the end. Here, she used checks from the account to pay her mortgage, and she took cash out of the account. In this particular one, total provable was almost $3,600. In this particular case, they found out because the president of the organization got back in the mail notice from the bank that said a check had been declined due to insufficient funds. And they're like, we should have enough money. We always have enough money. They talked to the treasurer. The treasurer's like, oh, no, that's an error. It's all been taken care of. I got it all corrected. There's $2,000 in the account. It's fine. Unfortunately for my defendant on this one, a new member of the organization worked at the bank. And that person was like, no, that account's been emptied and closed. So yeah, they dug in a little further and found out that she had taken all of that. And some of the lessons we can learn from this one is she didn't have any documentation to support a treasurer's report. She was getting oral treasurer's reports. No bank statements, nothing to back up where the money was going, no income, no outgoing, any of it. So, and everybody just relied on her to know what she was doing, and that's dangerous. So separation of duties is important, and board oversight is important, or employer oversight is important, because you can't just have one person doing it, or it's really easy to start nickel and diming and all of a sudden you've got $3,600 missing. And they never think it's that total amount. They're like, oh yeah, it was a couple $100s, and then it's always surprising to them how much the grand total actually is when we get down to proof. All right, the next two are related to fraudulent transactions. So we're getting a little more creative with our thefts here. It's not just people stealing out of the till or stealing out of the accounts. This particular one, an employee created fraudulent transactions for trading in old cell phones for gift cards. So there was a practice where if you brought your cell phone in, you got a gift card back for it. And so this defendant was making false returns of cell phones and then issuing herself gift cards, $500. And she also admitted to the investigators that she took $500 out of the cash drawer too. So total provable value, almost $4,000 in, I think this was a couple of months. Some of the red flags for this one were that it was an unusual number of transactions. Normally you'd get, one here and there, and then it was just continuous, very regular transactions happening. And it was caught quickly. So the bookkeeper for the business went, hey, this doesn't look right. I'm going to start digging in, and almost immediately found the employee's theft on that one. So it was a great example of that. And the defendant admitted, she said it was medical bills and that she wasn't able to afford her medications, food, and gas. And so she started taking from the till. Another similar one was fraudulent transactions of milk bottles being returned. So the scenario was if you could buy milk in glass bottles. And if you did, you put a deposit, it was either $1.50 or $3, depending on what size it was. And then when you brought the empty bottle back, you got your deposit back. In Oregon, they do that with pop cans. You can make a lot of money returning pop cans there. It's great fundraisers. But this defendant had started making fake returns. And so every so often return one or more of these milk bottles and just create the transactions and pocket the money. Total value that we were able to prove was a little over $1,000. And the red flags on this is the bookkeeper caught it. Discrepancy between the number of bottles going out and the number of bottles being returned. So it was just something that was like, hey, that doesn't look right. These numbers aren't consistent at all, that we're getting way more bottles back than we were actually selling. And also that it was sole transactions. So normally when people would bring their milk bottles back, they'd be buying other stuff. And it would just be a $1.50 or $3 credit against whatever, as opposed to bringing a bottle in, getting your $1.50 or $3 and leaving. So those things triggered them to look into, and I'll get to the question in just a second. This was another good example of oversight and seeing details, because the bookkeeper's like, something's not right here. I'm gonna look in a little closer, and they found it. So the question is, sounds like most of these case studies involve a female. Are they most commonly committed by women? That was actually something I noticed this morning when I was working on putting these together. I'm not gonna say most of them, but a little bit higher rate of women. I think it's because it's easier access and they're not as suspected a lot of times. I did have a couple of cases that didn't make it into my case studies that were men. One of those being someone that was taking actual physical items from the employer and then selling them on eBay for reduced rates. So there was that one. I did have, someone that was, it was a little complicated to try to explain, so I left it out. A student group had some pull tabs at a business. They were paying rent, and that person was supposed to manage and then give them the profits back. And there was some issues with the record keeping, and apparently I think it was about $5,000 ended up in that guy's pocket. And then the other one that I had on my list of potentials was actually a lawyer who was a partner in a law firm, not a Winona case. It was actually a conflict case that I handled for Olmsted County. And this lawyer, a check for their clients, an insurance payout came in, and he signed the check to himself and deposited it in his personal account instead of a trust account. And then his position on that was, well, I was going to earn the money anyway. So probably needless to say, he's been disbarred, which is good for everybody. So it's not just women, it's just a lot of the ones that I've got here are. So it's probably about 60-40, maybe 75-25 in the cases that I pulled as some of the complex financials. So next one is a theft from yet another children's organization. This one was a failure to deposit cash. So the treasurer, the practice was they'd have fundraisers and other things. The money would go into a bag, be given to the treasurer, and somehow only the checks got deposited, and sometimes not even the checks got deposited, but not the cash. So total provable value was a little over $13,000. Almost drove this organization out. This organization had horrible additional side effects, like the fact that the treasurer hadn't paid the taxes. And so they were facing huge fines. They almost lost their nonprofit status. They had all these things going on, almost didn't make it back from this. The bills weren't getting paid. In this particular case, the defendant stopped coming to meetings. So the treasurer suddenly not able to attend standing board meetings, a little bit concerning. There was a lack of treasurer reports. It was always promised and never really followed through on. I think they had a couple of them, but there were discrepancies. And when asked about them, there was never really a good answer behind things. And in talking with the victims in this case, they said that in hindsight, it was clear that this person was always living above their means. That it didn't, their lifestyle didn't quite make sense with what they were bringing in. With this one, they had an internal investigation. Their former treasurer was an accountant, so that person was brought back, and they spent hundreds of hours digging in. And most beautiful package I've ever gotten for one of these cases, but it's a lot of work. But she pulled everything together and detailed it. They found that cash amounts noted on event documents were never deposited. Their tracking system wasn't sufficient. They thought it was. They were actually doing a really good job. Their tracking system, when you checked out the cash box, you had to sign off on how much cash was in it. When you brought the cash box, and so did the person that you checked it out from. When you brought the cash box back, again, same thing. Both parties had to sign off on how much money was in it. The problem was when you brought the cash box back, it was to the treasurer. And from getting the cash box back to the deposit at the bank, there was no oversight over that deposit at the bank. So they thought they were doing a really good job, but there's always room for improvement. With this one, let's see. Yep. All right, we're getting into more and more complex ones now. This one actually is it's a pending case, but we have just resolved this case. So I'm comfortable talking about it. Also, I'm only going to talk about the stuff that's public record. This defendant wrote checks to herself out of the organization's account. And pretty blatantly. It's a really interesting one. $106,690 that we can prove. We know that there was substantially more. We just can't prove it. This one, it was as an employee of a school that was in charge of a script program. So again, stealing from kids. How many of these cases are stealing from kids? That's what's crazy to me. Gift cards at a school fundraiser, you purchase at a discounted rate, you sell them to people and keep the money you make out of that. So some of them they were purchasing through an online vendor, which is easy to track. Other ones you purchase from local businesses directly, and those are not so easy to track. Unfortunately, this defendant was the sole person handling that program. So responsible for the checkbook, the bank account, purchasing script cards, and distributing script cards. So all in one package, kind of a problem. She got caught because people started complaining they weren't getting their cards. And when they looked, normally the stack of cards that they usually had on hand to distribute weren't there. So there was some issue going on. An audit found that there was an excessive number of checks she had written to herself. She claimed that she admitted writing the checks, said that they were to purchase script cards. The weird part was she said that she was writing the checks to herself, cashing them and using the cash to buy the cards, except she also said she had the checkbook on her all the time. So why didn't you write the check to get the cards? It's a good question. Eventually she admitted taking the money because of she fell behind on bills, things like that. Unfortunately for her, when it got turned over to law enforcement, they did some bank record searches and found a whole lot of transactions at Treasure Island. And so they got records from Treasure Island. Apparently you can subpoena the players card records from Treasure Island. And they found that she had gambled in a 2-year $23,000 and only won $381,000. So gambling problem. Probably resulted in her financial difficulties. So on this one, they noticed the money was missing. And another employee actually called her out. There was a financial policy that said all checks, if it's a check to an employee, it has to be signed by somebody other than that employee. Really good policy to have in place. She convinced another employee, which was a brand new bookkeeper, that nobody really follows that. It's fine. So because she convinced them of that, she was able to just keep writing herself checks. There was also an issue where she was in charge of one account and money for a different account would come into the school, and somehow some of that money also got deposited into the account she was in charge of, even though she wasn't supposed to touch that money. It was supposed to go to somebody else. But it looks like she did that to cover overdrafts. And then participants were complaining, so that's why they started looking in. So some of the lessons on this one is, checks need to be signed by different employees, and employees need to be trained that it's a policy. You have to follow it. I don't care what this person tells you. You have to follow this one. It's important. Look closely at outgoing checks. So somebody somewhere had to see those bank statements, or should have seen those bank statements. Bank statements now come with images of checks that get deposited or that are written out of your account. Look at them. You might scan over them if you're in a hurry and you just see, oh, yep, written to that person for script cards, no problem. But look and see that the person that the check was made out to is the same person that signed it, and question it. I think your bulb just burned out, or it shut down for some reason. Okay. We're going to pause for a second to see if we can get this running again. Otherwise, I can pick it up from my screen.
You do have sharing capabilities.
Yep. We'll give it a second to see if you can get it rolling.
What do you think happened?
I heard a pop. It sounded like a bulb, but the light's still on, so I don't know.
It very likely would be the bulb because it's never been replaced.
Okay. I was at a prosecutor's conference one time, and we had a projector sitting like right here, and the bulb blew, and it sounded like a gunshot, and half the class hits the floor. Like, yeah, yep, we've gone through active shooter trainings. It might have just overheated also. I don't know.
It's never done that before.
Good times. All right. So I guess for those of you online, so the rest of the stuff on the PowerPoints, you guys aren't going to be able to see, but there's only a couple more slides. So I'll talk about it in detail.
I can't even get it to turn up on that.
Because I'm seeing it on the screen. So it's whatever you're doing is moving slides.
Okay. It's moving slides.
Yeah, because we're on case study 8 that I hadn't started talking about yet. We're halfway through it. We almost made it through without snafus. Right?
Now, right? You think you've got it all figured out.
Previous. All right, so next case study, well, case study 8. Going back to case study 7 before I finish that up. With that one, the plea agreement that we reach is actually going to keep a conviction off of her record unless she screws up probation. And the reason for that is because she has a really well-paying job now, at least a decently well-paying job, and she is agreeing to pay every penny of that back. And so the determination was that having to, and it wasn't necessarily about the money for the organization, it was about the fact that it's a consequence, because if you have a conviction, you lose your job, you're angry about it, and you don't pay anything, which understandable and probably not unreasonable. But paying $500 a month every month and writing a check out every month for the next 20 years is a reminder of what you did and what you have to pay back. So that was the basis for the agreement that we're going forward with on that one. But it's one of those things you have to keep in mind. If we went with a conviction, yeah, she loses her job, but then what? There's no other consequences other than that. Isn't it better to pay it back and have to acknowledge it every single month for the rest of it? For this person, it's pretty much going to be the rest of her life. So it was an interesting discussion. I actually had that discussion with the victims late last week, and we went around for 20 minutes about what's the right way to go here. So, all right, number 8. This one is another theft from an employer. It's a fraudulent reimbursement one, but it's a very complicated fraudulent reimbursement one. The provable value, and cursor on this. Come on. Oh, stop it. The mouse does not want to work on here at all. All right, so I'm gonna just ignore the PowerPoint too, and people online can be in the same position you guys are in.
Do you want me to just click it from here?
Sure, if you want to try that.
I just can't see, you just have to tell
I
me.
need to tell you when to click. Okay, so it's a theft by swindle
Does
case.
this work?
Click. Try again. Nope, all right. That's all right, we'll make this up as we go. All right, so find my backup plan here. All right, so it's a theft by swindle. The total provable value in this particular case, $83,752.24. In this particular case, the person was caught because the old employer found out that the defendant had been charged with theft from her new employer in the state of Kansas. So they then triggered a audit of their own records for the time that she'd been employed with them. And the audit found 21 suspicious invoices, contacted the businesses on those, learned that the invoices supporting the reimbursement request had been faked or altered, that those were not real invoices, and went from there. So the purchases were for technology, software type stuff. And when law enforcement was brought in, there was a review of her bank records, and none of the expenditures that she made out of her bank account matched what she said she had spent on behalf of this business for reimbursement. So she was claiming she bought this software for the organization, didn't really get reimbursed to the tune of $83,000, which is a lot. On this one, let's see, some of the red flags on this were on the invoices, her home address was used as the shipping address, not the business or not the organization. She submitted invoices for reimbursement, not receipts. And sometimes there were receipts, but those were forged too. And then on some of those invoices, there were some red flags and other issues. So some of the invoices had no order or reference number on them. Totals didn't add up. So it was like this item and this item and this item, but the total was different than what the total of those items should be. There were some discrepancies within the same receipts. So it would say this was this much, but then subsequently it would say it was that much. So there were issues with that. Let's see. So with all of that, she was, unfortunately for us, well, I guess fortunately for us, she had moved to Kansas. And so we were able to charge it even though it was about 7 or 8 years later. But we were able to go after her and get this ordered too. So she's on probation for this, has paid more than half of her restitution back as of this morning when I checked. So that's always a good sign that they're actually making their payments. Some of the lessons from this case are question invoices and lacks of receipts. It's really easy to see an invoice and go, invoice matches, request, done, I'm busy, move on. But take a look at it. Does the order number, is it missing an order number? Is it missing a reference number? Is there something about it that doesn't seem right? Is it a home address of the person instead of my business? Just little red flags, just things to question, not necessarily assume something bad happened. It might just be that they had autofill used for their home ad and it defaulted to their home address, but at least question it. Have someone that knows day-to-day operations involved in the process somewhere. So one of the things about this is she was saying she was buying these software packages for the organization, but then there was no corresponding software installed on the computers. So if you're spending $83,000 on software, there better be something you can look at and make sure that it's there. And also have an organization credit card to use for stuff like that. If you're making online purchases of software, why is your employee doing it out of their own pocket and getting reimbursed? That seems odd. So if you minimize personal reimbursement opportunities for non-emergency business expenses, it's going to make it a lot harder to steal from you. And then the last one, and the most complicated of these cases, is the only male I have on this list, but it is the most complicated. This individual stole from his employer to the tune of, oh, where's my number? How do I not have my number in here? It was at least 35, 45. Oh, come on. I didn't put it in my notes. That's fun. Maybe I put it in this. It was a lot. Oh, $83,933 over the course of a couple of years. And I haven't put my computer before that. Okay, give me just a second because I'm going to repeat the, oh, you have to enable my video again though. I'm going to repeat the discussion we just had for those online. Okay, so sorry about that for those online. We had a technical difficulty and my computer shut down, so we had to start it back up again. While we were on a break, there was a question about whether it's common for local businesses to just avoid filing charges, prosecution in the first place. And from our discussion, we think that that's probably true. It would be nice if we could get more of these cases so that we can make it clear to people in the community that we do in fact catch them. And that we can always work on agreements that keep the business out of the public view by either doing pre-charging agreements or making sure that we know what level we're willing to go to for a plea agreement in order to get some consequences without making the business's name public. All right, so, and then question.
Mine was a follow-up question. So when you're doing background checks or verification of employment, if it never gets out there, how can you protect your organization? You do your diligence to check employment, personal, those types of things. Sometimes they might give you red flags that will indicate to you that there's something fishy going on here, but employers really hesitate to make a negative statement about someone because they're afraid they'll come back to them.
So the question is about background checks and how if it's not getting reported to law enforcement and then it's not making it onto a criminal record, how is there any way to know about the prior history? Short answer is no. It's not documented. It's not anywhere that even I would have access to, and I've got access to arrest records, not just conviction records. I can, sometimes it gets reported to law enforcement and there's a record that was reported and not followed up on at the request of the victim. But I don't think that's anything that you would have access to. So it's a struggle. So for purposes of helping your fellow business owners, it's probably helpful if you go through the steps of at least reporting it and getting charges, because then others will know that there's this history. So for some criminal background checks, arrest records are included. For others, it's only convictions. But at least if you can get that information, somehow it's helpful. It can't be guaranteed if it's not in the system.
Is there someone, or would you recommend, if one of us had an instance, is there someone you could talk to, to know if it was worth going through all the work that we need to do to, prosecute or make that?
I would suggest, so assuming you're in Winona, I would suggest Winona PD. They've got a couple of and the question for those of you online is there someone that they can go to find out if it's even worth going forward with an investigation and charging? If you talk to law enforcement, they'll tell you what it would take in order to be able to move forward. They can always bring me in to talk about or to look at it and say, yes, there would be enough to charge if we had X, Y, and Z, or yes, there is now. It's until we know what we're dealing with, it's hard to say yes or no, but we're always willing to have the conversation about whether or not it's something to push forward on. All right. So let's see if I can remember where we were at. I have to find my notes.
I went to prevention.
Yep, there was a couple more things I wanted to talk about on number 9, because we didn't talk about number 9. We started to. So number 9 is a theft by swindle. Again, almost $84,000. On this one, there were 2 issues that were going on. One is he used the credit card to pay his gas bill twice, his phone bill once. The other was, this is where it got complicated. Couple of different ways he would do it, but they had a records management system where all invoices, all estimates, all invoices, all this stuff and payments were supposed to be tracked. He used the system to delete the invoices, mark things as paid with a credit card, even though there was no corresponding credit card income component. And then he would destroy the physical file. So it looked like there had been, if you looked at one set of records, it looked like there had been an estimate done. If you look at another set of records, it looked like everything had been paid. This would have been caught by the records management software, actually. It would have been caught, except that he didn't install the updates. That one of the new updates was that this report could be generated, which was very smart. One of the rare times I'll ever call a defendant smart. Did a really, really good job, really creative job on this. So it would have been caught if he had installed these updates, and it was found because they hired a new employee. their business was expanding, hired this new employee. The new employee, within 3 days of being there, who was being trained by the defendant, noticed that the records management system that they were familiar with was 6 updates behind. And the updates contained reporting functionality that would help find accounting errors. Also noticed that a customer came in and paid in cash, and the defendant had the new employee put that cash into a folder, into the customer's folder on the manager's desk. And the next day, the new employee was talking to the manager about that, and the manager's like, "What money?" And they started looking, they found the folder on the defendant's desk. And the defendant said, "Oh, I'm just getting it ready for deposit." There was also, the new employee also discovered that the defendant had fabricated a credit card purchase for the invoice, deleted that exact purchase, had suddenly said it was paid by credit card, and the invoice was gone. So the new employee then asked the defendant about that and the fact that there was a bill that was unpaid, and the defendant put his keys on the desk and walked out. So I call that an admission of guilt, but that's just me. They installed the updates. They were able to generate the reports. They went through and found many invoices that were for services that had been performed, deleted, and then only an estimate. And then they talked to customers, and the customer, because they saw all these transactions, they were like, "We got to follow up." They started calling customers that they knew. And the customers were like, "Oh yeah, he told me that if I paid cash, I could get a 10% discount." So they paid cash, and it never made it into the system. So most customers gave the exact same version of how that all played out. So lessons for best practices on that: update your software. Usually there's a good reason they're doing updates, and it's usually to make it better, more secure. One of the things I'm learning in my cybersecurity program is that security updates make things better. They make sure that you can't be hacked. They make sure that you are less likely to experience fraud. Review your credit card statements. They didn't notice that somebody was paying their gas bill until 2 or 3 years, 4 or 5 years later. They went back and looked and went, "Oh yeah." Luckily for us, he was a Wisconsin resident, so we were able to go back multiple years on his also. And then don't just have one person doing everything relating to money. It's dangerous. So with that, one of the common themes we saw through all of these is most often it's a trusted person with minimal oversight. So yay Midwest, people are generally trustworthy, but not everybody. They started small and it snowballed. So it was $20, and then it was $50, and then it was $100, and then they're like, "Oh, it was only a couple $100. Holy crap, how did it get to $10,000? It's always a shock to them. And then that lack of separation of financial duties, right? Good times. All right, we'll keep going because I've only got one slide left. Oh, it's back. Okay, prevention. So some of the things you can do to avoid it, I think you're probably gonna already have an idea on these from the examples we talked about, but have and follow financial policies and procedures. Have them in detail, make sure that they cover the scenarios you need, make sure that you're separating out those duties and that people are doing what they need to. Maintain detailed financial records to track the money throughout your organization as it comes in, as it gets into your account, as it goes out of your account. The more documentation you have, the easier it's going to be to prevent it and then track it if it does happen. Don't just have one person handling money. I'm jaded and cynical, and I don't think the best of anybody, unfortunately, but you can usually think the best of people, but one person handling money is dangerous. It's tempting. If you are dealing with cash all day, every day, and nobody's looking, it's really easy to pocket 20 bucks and just keep going. And then pay attention to the details and the red flags. Everybody's busy. We all have really hectic lives, but the finances are important. So take the time to look at your bank statements, look at what's going in, and look at it in detail. Don't just glance at it. Make sure that numbers are matching. Make sure that things are going to the right places. Make sure that employees aren't signing checks to themselves on a regular basis. Things like that. And just pay attention to those details because you'll start noticing those red flags. And then you can start questioning. And with that, thank you very much. Questions? More questions? Yes.
Because I sit on several nonprofit boards, when you have a change in, say, the treasurer position, What do you recommend for audits and how to do that?
So the question is, what's a recommendation for a nonprofit when their treasurer changes? I don't know that an audit's necessarily necessary if you've been doing your job as a nonprofit board member. So you have your fiduciary responsibilities of making sure that you're watching the money. It's not just the treasurer that's responsible for that, it's the entire board. So if you're doing your due diligence, you should be fine. It should just be a matter of, here's the policies, here's the books, seamless transition. If you think that there's a concern, get an audit, talk to somebody, or have somebody come in with fresh eyes and just look at it. Even if it's the new treasurer, just have them come in and look at it. I'd also suggest having the old treasurer do a training for the new treasurer with the entire board, not just one-on-one, because you don't want them training on bad practices and have bad practices continue. You want them to train, but also have everybody get the same information. It also helps the board understand how money is usually handled, and it can help you see if there's any issues or concerning practices. And then, maybe regularly review your fiduciary responsibilities for your organization with your board.
Recommend like a CPA once every 5 years or 10 years of audit, things just for good practice.
I think that's up to your organization and what's reasonable for your organization, because every organization is different. I've been on some where it really wouldn't make sense. You have a single bank account, you write 3 to 5 checks a year. It's, dues come in, dues go out, and sometimes you have an event. I don't know that it's really necessary on something like that. There's complex organizations that maybe it is, have a standing every 5 years we get an audit, just to make sure everything's good to go. It kind of depends. But it's not out of the realm of reasonable either. So question about, can we get a copy of the PowerPoint? Yes, I will make that available to Christine.
Is there recommended verbiage that you would put in a credit card policy? Like we have company cards, recommended verbiage to put in a policy, in a statement signed by the card holder that would help us prosecute later if they didn't, if they used it for personal use. Or
I have a couple of policies that I've seen that are decent. I can make samples available. I'm not going to recommend it because I'm not technically allowed to give you legal advice.
And we have a good one too. I just
Yep, I can provide a couple of samples for comparison that you can look at. Yeah, I'll provide it to Christy. She can make sure it goes wherever. So,
I'm gonna go back to the nonprofit again.
Do we need to go to the Black Horse?
So when you have a checking account, it's always recommended to have for nonprofit 2 signers.
That's a good one. It's not always reasonable for some organizations, but that is a good policy. At a minimum, it should be, you can't sign checks to yourself. But 2 signers is a good policy when you can make that work. I know I'm the president of the League of Women Voters here, and we do not have that policy, even though it's a really good one. And the reason is because we are all so spread out and ridiculously busy that trying to find 2 people that are authorized to sign a check would take weeks. So it's a little complex, especially during the pandemic, because I don't even live in Winona. So it would have been almost impossible to get 2 signatures on checks.
We don't have 2 signers on a check, but we have 2 people who have access to the bank account.
Yeah, and you at least want to have 2 people having access to the account.
Here, you can check any time. You double check.
Yep, I think so. League of Women Voters, what we set up when I took over, instead of having 1 person in charge, which is how it had been, and it had been going fine, it's the president, the membership chair, and the treasurer have access to that account, because membership is the one depositing and they want to make sure that dues get deposited. So those 3 for us have access, and we're all authorized signers on checks. And we have it so that our policy is, whenever possible, it has to be 2 signatures. If there's not 2 signatures, there has to be an explanation at the next board meeting. But we also only write, a handful of checks a year, so not a big deal.
Is there anything, I often wonder, connections between employees and vendors? You know, we've done some checks to find things. If the vendor is the employee,
Right.
But what if there's a relationship, or because that's two people involved, is it less likely?
I guess it depends. So the question is about vendor and employee relationships and whether, you know, how you can figure that out. I always recommend a conflict of interest form for all employees where, you know, and I have to sign one once a year about what outside stuff I am associated with, because then you can know what they're associated with. But depending on how those are phrased, it's usually related to financial relationships. So if they're not, you know, if it's just their brother-in-law that's doing it, it's different than if it's their, you know, somebody that they're paying or that they're getting, if they're an investor in the vendor's business, which is technically what a conflict would be. I think you can keep your ears open. I'm not sure you can directly ask, are you related to or friends with this person? Honestly, the one cases I've seen have not involved relationships. It's been people stealing for their own benefit, not working with others. But it can happen. That is a red flag if there's a personal relationship or a family relationship with a vendor. So something to keep your ears open for. Actually, Winona County got sued over an employee termination for somebody that was a investor in a business, and that business then got a contract with the county. And then when it was discovered, the employee got fired, and it was a termination lawsuit. So it was interesting.
So conflict of interest, do you, we have conflict of interest policy that at a certain level everybody signs, if you report to a VP, but not everyone signs.
Right.
Do you recommend everyone sign? I mean,
I don't see what the harm is.
right.
It's, I mean, we make like Board of Adjustment Planning Commission members sign it every year. As part of it, we do an annual training right after the new board takes office. We walk through it, everybody goes through and signs their conflict of interest, their hostile work environment policy, and some other stuff. And it's just, we just do it standard and nobody flinches at it anymore. I have to do conflict of interest and outside employment every time, once a year. I think it's in January. So just as long as it becomes routine, it's not usually a big deal. Other questions? Well, I have cards and Christy has my contact information. If anybody has any questions, I'm always happy to provide more information. So I would love to put myself out of a job on these because it would be nice if it wasn't happening. It's a lot harder to deal with it for you guys, for us afterward. So let's stop it from happening in the first place.
Thank you so much.
Thank you.